Assalamualaikum and welcome to our group presentation. Right now, as you can see, we are going to discuss about development of Iskandar, Malaysia. Before we start, let us introduce our members. Nur Afrina binti Abdul Razak, Nur Tashayu Hanana binti Syaiful Azli, Muhammad Ikwan Hanif bin Syaiful Azli, Nur Maisara Syafiqah binti Aidi Mazli, Muhammad Razik Daniel bin Muhammad Hilman.
The Iskandar Regional Development Authority (IRDA) is a statutory body established under the IRDA Act 2007 to coordinate and promote the development of Iskandar, Malaysia, a major economic growth corridor in Johor. Although IRDA is not a profit-oriented entity, it manages and evaluates large-scale investment through its subsidiaries and strategic partners, particularly Iskandar Investment Berhad (IIB). Now let's talk about the Iskandar Malaysia. What is Iskandar Malaysia? Iskandar Malaysia is a large regional development corridor that was instituted by the government of Malaysia with an aim of improving the economic development, especially the state of Johor. And it has been formed under the Iskandar Regional Development Act 2007, where the vision is to build the metropolitan area globally, where economic activities and the city, environmental sustainability and social development are in balance. Now, what is Iskandar Investment Berhad (IIB)? IIB is a government-affiliated investment company that is very vital in the implementation of strategic project in Iskandar, Malaysia. Khazanah Nasional, which is the EPF, Employees Provident Fund, and Kumpulan Prasarana Rakyat Johor Berhad are the major shareholder of the IIB. So, in this case study, the project under consideration is a proposed capital investment project in Teluk Bahang, Johor, which is to be carried and assessed by IRDA. Due to the uncertainty cash flow and magnitude of expenditure, IRDA must decide either they want to make an investment or not. So, in this case study, it aims to evaluate the project of Teluk Bahang, Johor in terms of the financial and investment worthiness of the project.
I will be discussing for the question number 1, which is capital investment process. The capital investment process that is made by the Iskandar Malaysia begins with the formation of Iskandar Investment Berhad (IIB). IIB was established on 2 November and was formerly known as South Johor Investment Corporation Berhad. IIB also was formed when the head of agreement was signed to form the new company in order to stimulate development of catalyst project. For the IIB shareholding structure, IIB consists of 60% Khazanah Nasional, 20% EPF, and 20% Kumpulan Prasarana Rakyat Johor Berhad (KPRJ). For the asset initialization, IIB was established with approximately 3.4 billion ringgit assets consisting land and cash. IIB also owns a significant land bank in the South Johor through subsidiaries and joint venture company. Next question is the question number 2. Is to discuss the scenario analysis and the sensitivity analysis. For the scenario analysis, it is an analysis to estimate the impact on the firm's future outcome by changing multiple variables at once. Analysis is made by assigning the value based on the estimation into the variables for the 3 different scenarios. The scenarios for the estimation is made for the base scenario, best case scenario, and the worst case scenario. For the sensitive analysis, it is an analysis focusing on the changes in one input variable at a time, affecting the degree of the outcome while maintaining other variables constant. This analysis helps to identify which input have the most influence on the future outcome.
Scenario analysis pada Teluk Bahang project goal. Their goal is to test the project by applying 10% change in the sales quantity, sale price, and the variable cost. The first one is the base case. We start with the base of 1,000 units sold at 5,000 ringgit for each, with a variable cost of 3,000 ringgit per unit. Next is for the worst case, we reduce the quantity by the price 10% while increasing the variable cost by 10% also. This gives us a lower bound of 900 units at 4,005 ringgit for each. Lastly is for the base case. Conversely, we increase the quantity and the price by 10% and lower the cost, resulting in 1,100 ringgit at 5,500 for each. our fixed cost is remain constant at 400,000 ringgit across all scenarios with a tax rate 35%. Next, we calculated the operating cash flow (OCF) using the tax sheet approach. The formula is as follows. Base case OCF by taking our 2 million ringgit gross profit, subtracting with the fixed cost, applying with 35% tax rate, and adding back the depreciation tax shield, we arrive at an operating cash flow of 1,092,500 ringgit. Next is for the worst case OCF, when the margin are squeezed. In the worst case scenario, the operating cash flow drops significantly to 494,500 ringgit. Lastly, for the base case OCF, in the most optimistic scenario, our operating cash flow increases to 1,794,500 ringgit. Overall, these figures show that even in our worst case scenario, the project is still able to maintain a positive operating cash flow. Finally, we determine the project value using the net present value (NPV) method over a 10-year project life based on the 15% required rate of return. To calculate it, first, we determine the PVIFA or the present value interest factor of an annuity at the 15% over 10 years, which is the 5.0188. We then apply this factor using the NPV formula base case NPV. With an initial outlay of the 1,500,000 ringgit, the base case produced a strong net present value of the 3,983,039 ringgit. For the worst case NPV, even under stressful condition, the project remains viable, generating a positive net present value of 981,766 ringgit and 60 cents. Lastly, for the calculation in PV, for the base case, in the best case scenario, the project delivers an impressive net present value of 7,506,236 ringgit and 60 cents. In the conclusions, since the net present value is positive across all three scenarios, the Teluk Bahang project can be considered a financially robust and attractive investment for IRDA.
For question 5, we analyze the sensitivity of operating cash flow to variable costs by testing a 10% change in both directions. First, consider our base case, where the variable cost is 3,000 ringgit per unit. In scenario 1, the cost increase. If costs rise by 10% to 3,300 ringgit, our cash flow drops to 897,500 ringgit. This is a drastic decrease of 17.85%. In scenario 2, the cost decrease. If costs fall by 10% to 2,700 ringgit, our cash flow jumps to 1,287,500 ringgit, representing a gain of 17.85%. Now, look at the slope of negative 650. It stays the same in both cases because of the inverse relationship. Whether we calculate the loss from the cost increase or the gain from the cost saving, the result is negative 650. This proves that for every 1 ringgit increase in cost, we lose exactly 650 ringgit in cash flow. Moving to question 6, we identify the strategic risk for IRDA based on that data. First, we face high volatility because the slope is steep and negative, meaning small price changes create massive swings in profit. A 10% cost hike destroys nearly 18% of our value, creating a critical margin risk. Second, this volatility impacts the social mandate. In the worst case, we lose 195,000 ringgit in liquidity, which limits fund for the Social Project Fund and the National Talent Enhancement Program. However, in the best case, that surplus would expand these programs. Therefore, our recommendation is that IRDA must stop relying on market luck and implement strict cost control. We advise signing long-term fixed price contracts or including cost escalation clauses to eliminate this volatility and protect the project from that negative slope.
Today, I will explain the best case financial break-even level of output for the Teluk Bahang project. calculate the degree of operating leverage DOL and conclude with an investment recommendation for IRDA. Financial break-even occur when the net present value or NPV is equal to the zero. This means the project generates just enough operating cash flow to recover the initial investment at the end at the required rate of return. The NPV equation is NPV equal to initial investment plus operating cash flow multiply PVIFA. Substitution the given value 0 equal to minus 1,500,000 plus OCF multiply 5.019. Solving for OCF. OCF is Ringgit Malaysia into 268,864 Ringgit Malaysia 0.32 cent. This is the minimum annual operating cash flow required for the project to break even financially at a 50% discount rate over the 10 years. Next, we determine how many units must be sold to generate this operating cash flow. This is the operating cash flow formula and substitute to 268,864.32 equal to 5,000 minus 3,000 multiply Q minus 400,000 minus 150,000 multiply 1 minus 0.35 and minus 300 and minus 150,000 and it solves Q into 389.59 units. Rounded up the financial break-even level into 360 units. The degree of operating leverage measures how sensitive operating cash flow is to changes in sales. This is the formula and this is the substitution of the value. So DOL equal to 2.3384. This indicates that operating cash flow is highly sensitive to sales volume. The Teluk Bahang project reaches financial break-even at 390 units, which is a relatively low sales threshold compared to the 1.5 million ringgit Malaysia initial investment. This suggests the contribution margin is strong enough to cover fixed costs and depreciation efficiently. The DOL of 2.338 indicate a moderately high operating leverage. While this amplifies profit during a period of strong sale, it also increases risk if sales decline. A fall in sales would lead to a disproportionately large drop in operation cash flow. However, lower break-even level reduce project risk and increase flexibility as profitability can be achieved at modest output level. Although the project exhibits moderate risk due to fixed costs, the risk is balanced by higher upside potential. From a capital rationing perspective, projects are typically prioritized based on NPV, IRR, and profitability index. Since this project achieves zero NPV at the break-even point, any sales above 390 units will generate positive NPV, making it competitive. Additionally, if the project aligns with IRDA, broader Iskandar Malaysia development objective its strategy value further strengthen the case for approval.
As a conclusion, it can be said that project of Teluk Bahang Johor is very suitable for IRDA to choose as a project investment because it finally meets the financial criteria and also shows a positive financial performance. Overall, Teluk Bahang project is financially viable as it generates positive NPV across scenarios, achieves break-even at a low output level, and exhibits a manageable degree of operating leverage. Although operating cash flow are sensitive to changes in variable costs, this risk can be manageable through effective cost control and monitoring. Therefore, it is recommended that IRDA proceed with the project as it aligns with long-term development objective and offers sustainable terms.